This is the Friday, December 16, 2022 installment of Market Plus. Ted Seifried joins us. Ted, I picked up on a theme that you said during the main program. Don't be surprised about a shock. Now, a little backstory. I don't know if we fully explained it. I didn't in the show. Once we complete recording the television program, we compile some things and then get it ready for the web. News happened, like major news that impacted commodities after your last visit. I don't even think we'd sent the tweet yet to say the show was online. So things can happen quickly, and it seemed like some of your comments might have been out of date. So how does someone protect themselves on such a fast-moving market when things like that happen?
Well, see, I mean, if I can't do it when I'm on a show and then something happens Friday night and before the show airs, then I don't know how anybody does it, aside from I can't buy puts on what I say, right? All that being said, look, you've got markets that are at elevated levels. Okay, they're not at record highs, but historically speaking, we are at some really very, 650 corn is great, $14, almost $15 beans. These are some really very good prices. And yet we've had a long period of time where we've had mostly sideways markets, which means that volatility premiums are low, and that means that put options are actually really pretty inexpensive comparatively speaking. So there's a great way to put a floor underneath the markets, still have upside potential in case of South American drought or something good happening for the markets. And yet you don't have to worry about, oh, I paid a whole lot for input costs. I have so much risk this year. This is probably the highest risk year that I can think of in my career for producers. So, hey guys, let's do something to protect that so that we can sleep at night through a holiday season that has, at least the last few years, been really wild.
As Virgil Robinson used to say, as we sit here tonight, Mark. And that's what he meant.
Yeah.
Well, then I guess you might not agree with Scott in Wisconsin's question that he asked us on Facebook. Ted, why is the grain market so dead?
Yeah, that's a really good question, right? I mean, why have we been at these elevated prices? Why have we been so sideways? And the reason for that is because you can make a really good case both on the bullish side of things and on the bearish side of things. There's two sides of this market. Every day you see it. Right? I mean, we rarely have a directional day where we sustain that direction throughout the day. We'll be up, then we'll be down, and then we'll maybe come back again. It's a very, very two-sided trade, and all that two-sided intraday trade leaves us really very sideways. So we are deciding some things. We know that over time, these higher, relatively high prices are going to cause some demand destruction. But the question is when, and when does that shoe drop? And do we have one more big push to the upside coming from a South American weather problem or not? So all these things are yet to be determined. This is why we are looking at some quote-unquote dead markets. I don't know if I'd go as far to say that,
right?
Because we do have some pretty big ranges. It's just we don't have a very clear direction one way or the other right now.
Well, Greg in Peoria, Illinois, his question should say when, given what you just said, but he's asking what's the target price to start selling the 23 crop?
Yeah, and I don't know if it's so much of a target price as to when, really. I would like to see guys have 35 to 45, upwards of even 55 if you'll do it, of new crop priced by the end of the calendar year. Because usually that December bump we talked about in the regular show, that's a lot of times the second highest peak of the year, sometimes the highest peak of the year, because it's not guaranteed that we'll have a weather scare that pushes us higher in June and beginning of July. And like we talked about, I mean, there's a lot of ways to market grain and have the upside open. You can either buy puts to own a floor, to protect your downside, and wait to make the cash sales. You can make cash sales and own calls, which again, volatility premium down. Those are fairly cheap too, to re-own upside potential. But do something, right? Do something to have protection, because again, we've paid a lot for this crop, specifically corn. We've paid a lot for this crop. We're going to pay a lot for this crop. We don't have the same risk tolerance we normally would. You really have to protect the prices that we have in front of us, and quiet markets give you an opportunity to go and do that. So I'd love to say that 680 would be a target for old crop corn. But again, things can change in a hurry. We may not ever get there. We talked about earlier, 512 for new crop beans, or for old crop beans.
And that's a little bit, I'm going to tie Randall and then also Matthew asked, Randall was asking, what's it going to take for July wheat to break 9? And then Matthew's asking, what's going to have to happen to old crop corn to break 7? So some of the factors you've already mentioned, is that what you're saying? Okay. Good answer.
Well, the corn is I think more based on South American weather, triggering export sales. We need a sense of urgency to happen for these global end users to come in and start aggressively buying corn. Once that happens, it'll create a sense of urgency in the corn market as a whole, and then I think we can start talking about $7. But again, if these big, savvy, the largest buyers in the world, if they don't have a sense of urgency, it's really tough to make the argument that corn needs to go sharply higher despite weather problems in Argentina.
All right, we're going to skip ahead to an economic question. I told you at the end of the program we had another question from Canada. Phil, great question, but I want to get to KB in Manitoba. He's asking you, Ted, what is your forecast for U.S. dollar index as the Federal Reserve becomes less hawkish as inflation worries subside? How will it impact futures prices of corn, soybeans, and the 3 wheat classes?
Yeah, so the way the dollar index always affects commodities as a whole is that when the dollar is worth more, commodities are intrinsically worth less. Not worthless, but that dollar buys more of that commodity so that prices don't have to be as high. That being said, you had a reversal higher in the dollar earlier in the week. That I think may be putting in a near-term bottom. When we talk about our interest rate policies, we are expecting interest rates to continue to go higher, but the real question is what happens with the rest of the world? What happens with the other major currencies that the dollar is pitted against in that U.S. dollar index? I think there's room for that dollar to start going higher again. It has come off the highs really very aggressively. For my technical charting and everything like that, it's come down and it's hit its target to the downside. Now I think it's time for that to strengthen again. Now, whether it'll go make new highs or not, a lot of that is going to depend on what's happening in the rest of the world. But I think this break in the dollar that we've seen that has been beneficial for commodities, I think comes to an end, or at least comes to a pause here for a little bit.
All right, well, that's that side of that question. I want to get now Brad in Nebraska. He asked on Twitter, he's talking about the Fed raising interest rates. How does that change managed money flow into energy, grain, and livestock commodity sectors?
Okay, so the biggest thing that the funds, the managed money looks at interest rates or what the Fed's policy is in interest rates is basically telling them whether they should be risk on or risk off, right? And, we saw the half-point raise instead of the three-quarter-point raise that they had been doing. That half-point raise was very much as expected. However, you saw a risk-off day. Now, the question is why? Well, because the language that the Fed is using is suggesting that they're going to continue to raise rates, and the peak might actually be higher than what they had been talking about, even a month before. So that translated into risk-off. If that risk-off continues and interest rates continue, or interest rate hikes continue, then that's really not a good thing for commodities, because that is the Fed doing what they're trying to do, which is cool down inflation, cool off the price of commodities. But if the Fed really does slow down sooner than what they are saying, or sooner than what I think we had been expecting a month ago, that'll be a big risk-on event. So yeah, Fed, what they do going forward will have a very large impact on commodities and what the funds do with them.
Well, and the Fed has had this history of, you kind of talked about it during the show about how USDA, they don't change numbers, but yes, they do. Mm-hmm. Fed is, like you said, we're not going to do this anymore. And then all of a sudden they get to that next month, we're going to do what we said we weren't going to do. So do you think that the reaction that the stock market had, the equities and whatnot after the Fed's announcement, was the market response trying to tell the Fed something?
Well, okay, so Paul, a lot to unpack there. For one, the Fed has realized that sometimes their words are just as effective or maybe more effective than actually their policy. So they really do rely on the language of these Fed decisions to sort of be the bigger driver of the market rather than the rate hike or the interest rate itself, as long as it's not a complete shock as far as the interest rate is concerned. Now, as far as the equities and their response to that, I think there was some disappointment there because the idea is that, okay, the Fed's going to start slowing this down and moderating, and that's going to kind of continue to the point where maybe we're getting towards the peak. And it didn't sound that way based on their language. And so, yes, I do think that is the stock market saying, hey, no, wait.
Yeah.
Now is a good time to pause or continue to slow down, maybe only a quarter-point hike. Which is contrary to what the Fed language sounded like to me anyways, and to the market for that matter. So yes, I think that was the equities market kind of asking the Fed to maybe change their mind on what they had been saying.
You say this, but this is what we need.
Yeah.
All right, let's close with the question about land prices. Ted in Iowa asked us on Twitter. This is a common question this time of year as land sales happen. He's asking, what are the early signs that land prices have peaked for a cycle?
Yeah, hey, Ted. So there's a lot of things that will lead up to that peak. Higher interest rates are a problem because it's not as easy to get money, and if it's not as easy to get money, then it's harder to pay those higher prices. But that's not an indication that they have peaked. That's just something that can lead to that. A peak in commodity prices is another thing that can lead to that. If corn prices drop dramatically, it's going to be hard to justify the higher land prices. But I think the way you know that any bubble is burst is when people stop paying the higher prices, right? And so, you go to an auction, Ted, and all of a sudden, things are not moving at numbers that you thought they would easily move at before, then that's definitely a sign that things have peaked. And you wonder if we're on some thin ice with that. Now, you and I were talking in between the break. I'm not 100% convinced that we're headed for a major recession. And if that is the case, if the case is that we're not headed to a major recession, we could see a soft landing in farm values as well. So I don't know if there's a bubble that needs to burst, for example. That being said, things can and probably should cool off at some point, especially if we continue to raise interest rates.
Because if you want to look at charts, and you look at consumer price index and producer price index and all this other stuff that we both look backwards and look forward, it was up high, but stuff has gradually, slowly been heading down. We've talked about a pending recession. You've heard it on everything since, I say, June, July.
Yeah.
At some point, it just seems like wolf, crying wolf here.
Yeah, if I'm perfectly honest, Paul, I started talking about an inflationary bubble burst and a pending recession back in January and February of last year, almost a year ago. I was making some comparisons to 2008. I've since really kind of changed my mind on that based on how things have kind of reacted to the Fed raising interest rates, how things have reacted to everybody else saying, okay, we need to be headed to a recession. And also there are some fundamental differences on how that inflation was created compared to what happened in 2008. But more than anything else, I see people out there spending. I was giving
Give me the mall report.
Giving you an anecdote before the cameras were on, saying, I had to go to the mall for something earlier this week. The parking lot was completely full. The restaurants were completely full with an hour-and-a-half wait list, and people were waiting for it. People are out there spending money. There needs to be some sort of fear to have a recession. There's got to be something that keeps people from going out and spending that money, losing their jobs, losing their house, things like that. People aren't afraid of that right now. So I don't know. I'm not sure that we see it. I think a slowdown is, we're due for something like that, but I don't know if it's really going to be as bad as what the news media seems to be making it out to be.
We'll ask you about it on your next appearance. How about that?
There we go.
All right. Ted Seifried, good to see you. Thank you so much. Appreciate it.
Always my pleasure, Paul. Thanks for having me.
That's going to do it for Market Plus next week. We are going to look at rewarding those who help feed the world, and we're also going to have the analysis of Jeff French. Thank you so much for joining us, and have a great week.